Now this is very important. The gaps often signal a major reversal, often near one end of the range. Even if you're not a day trader, and of course this tape we're stressing day trading, look for gap openings to signal to you that the market has changed direction. And how does it change direction? By making it very, very hard on just about everybody. So when you get to a top, you'll get a much higher open, you'll get panic at the open, and then the market will close on the low of the day, and from then on, it'll just go down. At a major bottom, you'll get a market that opens lower, stays down there, goes even lower, turns around, closes up. It's called a key reversal day, and then go up. Now, like I say, these offer great opportunities if you know what to watch for. Now, in getting into the rules and calculating the gaps, we need to use some parameters. And one that we rely on, not just in gap trades, but in others as well, is the average range. I'll go over this because I think it's important that you know it, of course. And by the way, as we go through these formulas today, if you have any question about it, you can always go back to the book where you can find them. The difference between the high and low averaged over 10 days, that's the average range. The average range on a daily basis is the difference between the high and the low. So the average range equals 10 consecutive daily ranges divided by 10. That's all it is. It's an average of what the market tends to do in a given day. And like I say, this is an important formula to know. Here we have an example of 10 days of high lows and the day's range for each day. The prices I've selected here are in the S&P 500. As you can see in the column on the right, the 10-day average is not calculated until you have 10 days of averages. So you add up the 10, you divide by 10, and you have your average. On this slide here, you can see as we get to day 10, the 10-day average range is 3.45, whereas the day's range was only 215. You just take the 10, you divide it, and you can do this with a calculator and see it should be correct. Then you have the average on day 11, you drop day 1, you add the day 11, and you have 10 days, divide by 10, and again you get 3.30 here. This is all simple math. Now we have the two types of gaps, the extreme gap and the normal gap. The definition is the extreme gap exists when the difference between the open and the previous close is greater than the average range. And we're talking here about yesterday and today, only 2 days. The difference between the open and the previous close is greater than the average range. We know how to calculate the average range. We know what the previous close is, and now we know after the open today what the open is. So it's relatively simple to do this calculation. Now, there are different types of gaps, but for the gap to be meaningful, we'll talk about the up gap first. The open must be above the high of the last 4 trading days. In other words, you have 4 days, and now on the 5th day, it's even higher yet. On the bottom, on the gap to the downside, it's the opposite. It must be below the low of the last 4 trading days. And the reason for this is you want to make sure you've got a pretty major turn here. And that's why we insist on that rule. Now here's an example of the extreme gap. And again, I want to stress that you're not going to see this trade very often. But when you do, it's a golden opportunity, and you should be prepared to jump on it. This example is in the bonds, and we'll work through the numbers here. The average range is 1 and 5/32. We know this because we know how to calculate the average range over the past 10 days. We'll assume that today's open is 98.24, and that the previous close was 97.08. This means there's a difference of 1 and 16/32, or 1.5 basis points. The average range is only 105. The gap is 116. Therefore, it is what we call an extreme gap. Therefore, 98.24 signifies a gap opening in an extreme gap in which we'll want to immediately go the other way. It's now gapped up. We want to sell it, and so that it will return down to the middle. If it gaps down, we want to buy it and go the other way. You have to remember that this goes against, in a sense, the conventional wisdom in the herd mentality. The herd mentality is everybody's following everybody else. If everyone's buying that drove the market up so high, it must be going higher. It's the wrong way to think. You want to be a contrarian. You want to go opposite the crowd. Only the minority can win in the futures market, and this is how they do it. And it's very hard to do, by the way. Here is an illustration of 2 days. The previous close here was at the high at 97.08. These are the numbers we just talked about. And today's open is 98.24. This calls for an immediate sell at the 98.24. Open above 98.13 signifies a gap. We had a larger open than that. That's 105 added to the previous close here, and it opened higher than that. Therefore, you would immediately sell. Now, what happens if you get this gap and you don't sell? Well, I can tell you from experience what's going to happen is you're going to have to chase the market, and I don't advise doing that. If you miss a good opportunity like this, just let it go and wait for it to occur again. But it usually doesn't pay to chase it, because if you do chase it, now it opens at 98.24, let's say it's a very volatile day. In 5 minutes and 10 minutes, it could be all the way back to the previous close again. So if you sell it down here at 97.08, chances are it's going to be a volatile day. They'll run it all the way up to the top again, and you'll get out because you can't take the paper loss. So be prepared to jump on it immediately. Of course, you can't put the order in prior to the opening because you don't know what the opening is going to be. Now, these are the rules for the extreme gap. Money management is very important to winning in the futures market. I don't think that you can just take one lots all the time and win. If you are a one-lot trader, you have to be prepared to kick it up to 2 or even 3 or 4 occasionally. And when you get a trade like this that has a very high degree of probability, you have to be able to back it up with a little bit more money. That's why I have this rule that you should sell double the normal commitment immediately on the up gap. And I've seen this happen as a bond trader over and over again, where that opening is the high of the day. In other words, when you sell up there, you have no adversity. You're profitable right from the first. And that's what makes for good trades. And if it is a major reversal, it's not going to trade up there again. So you're not going to be able to say, well, it opened up where I wanted to sell it. I didn't. I'll wait for it to go back up there again. It won't. If it's a good trade, it won't. You don't want it to go up there again. And, of course, the obverse also applies here. Buy double the normal commitment immediately on a down gap. Now, I use the term normal commitment because I don't know what your commitment is. If you're a one-lot trader, go to 2s. If you're a 10-lot trader, go to 20. It depends on your financial situation. But do it certainly within reason. Don't be a one-lot trader and the next day decide you're going to be a 10-lot trader. If you're a one-lot trader, you go to 2s. If you're a 10, then you can go to 20. But keep your numbers in an area that you can live with it. Stop placement. As a rule, you want to have a stop because nothing is guaranteed to work correctly all the time. You never want to let your position get away from you. You can get hurt really bad if you let even one position get away from you. So as a result, we have this rule that 50% of whatever the average range is, you'll take your entry point, calculate where you got in, take 50% of the average range, and that's where your stop will be.